Welcome back, students and scholars. In the first video, we understood the big picture of ASC 235 and why significant accounting policy disclosures matter. Now we move from rule to note. This is where ASC 235 becomes practical. The standard gives us the framework, management applies that framework to the entity's own facts, and then the policy becomes a clear note that users can actually understand. ASC 235 does not write the note for us. It tells us when a policy disclosure is needed and what kind of usefulness it should provide. So today, we are not just memorizing disclosure techniques. We are learning how to convert accounting judgment into readable financial reporting. A good policy note is like a good map. It does not walk the journey for the user, but it stops the user from getting lost. Policy adoption starts with the entity's facts. When a business is formed, management must select accounting policies before transactions are recorded and reported. These choices may cover revenue recognition, inventory costing, depreciation, consolidation, and other major areas. Later, if the entity enters a new transaction type, such as leasing assets for the first time, it may need a new policy. Similarly, if there is a material event, such as an acquisition or a new line of business, additional policies may become relevant. The important point is that policy notes should reflect current and material operations. A note about a transaction the entity no longer conducts may create confusion instead of clarity. Disclosure should explain the business that exists, not the business that disappeared 3 years ago. Once an accounting policy is adopted, users expect consistency over time. If a company uses FIFO for inventory in year 1, users naturally expect the same policy to continue in year 2 and year 3 unless there is a justified change and proper disclosure under the relevant accounting change guidance. Consistency helps users compare trends in revenue, costs, margins, assets, and cash flows. If policies change silently, users cannot tell whether the movement came from real business performance or from accounting method changes. That is why clear disclosure is essential. In practice, policy changes should never be hidden inside boilerplate language. If the accounting method changed, the note should help users understand what changed, why it changed, and how it affects comparison. Now let us talk about disclosure effectiveness. More words do not automatically create better disclosure. In fact, sometimes more words create more fog. Effective notes reduce repetition, focus on the relevant policy, and remove outdated content. If the face of the financial statement already shows the amount, the note should not merely repeat that amount. It should add meaning. If the note combines 5 unrelated policies in one dense paragraph, the reader has to work too hard. If the note carries forward old content that no longer applies, it may signal weak review. A strong note is accurate, current, specific, and useful. In reporting, copy-paste from last year is not a disclosure strategy. It is a polite invitation for auditors to raise an eyebrow. The purpose of notes is to help users assess performance and cash flows. The financial statements tell users what happened in numbers. Notes explain how those numbers were measured, what judgments were involved, and what policies shape the reported amounts. Good notes enhance the statements, they do not replace them. For example, a balance sheet may show inventory, but the note explains the cost method, valuation approach, and any write-down policy. That information helps users assess margins, working capital quality, and future cash flows. Logical organization also matters. A reader should be able to move from the summary of significant accounting policies to specific note details without feeling like they are solving a treasure hunt. ASC 235 discusses several disclosure techniques, and each technique serves a different purpose. Parenthetical explanations are short facts placed directly beside a line item. Notes provide more detailed explanations. Cross-references connect related items across statements or note sections. Valuation allowances show how gross amounts are adjusted to net carrying amounts. Supporting schedules organize complex details in a readable table. table. The technique should match the complexity of the information. Simple facts can stay on the face of the statement. Complex policies need notes. Related items need cross-references. Large detailed data may need a schedule. The goal is not to use every technique. The goal is to choose the technique that makes the disclosure easiest to understand. A parenthetical explanation is a brief disclosure placed directly next to the related line item. It works best when the fact is short, clear, and directly qualifies the amount shown. For example, inventories may be described as stated at the lower of FIFO cost or net realizable value. That gives the user important measurement information without sending them to another page. Parentheticals are useful because they are highly visible. The reader sees the amount and the explanation together. But there is a limit. If the explanation needs multiple sentences, assumptions, judgments, or detailed policy context, then it belongs in a note. A parenthetical should be a quick signboard, not a full classroom lecture squeezed into brackets. Notes to the financial statements are used when the disclosure needs more space. If a policy involves judgment, estimates, multiple components, or special application, a parenthetical will not be enough. Take inventory again. A full note can explain that inventories are stated at the lower of cost or net realizable value, that cost is determined using FIFO, and that cost includes materials, labor, and overhead allocated based on normal capacity. That level of detail helps users interpret the inventory balance and gross margin. When a statement line item is supported by a note, the reference should be clear, such as see Note 1. That reference must stay accurate every year. A wrong note number is a small error on paper, but a big irritation for every serious reader. Cross-references are used when two related items appear in different locations. They help users connect the dots without forcing the preparer to repeat the same explanation again and again. A classic example is accounts receivable pledged as collateral for a bank loan. The receivables note may say that certain receivables are pledged. The debt note may say that the loan is secured by those receivables. Each note points to the other. This avoids duplication and reduces the risk that one note gets updated while the other remains stale. Cross-references are especially useful for pledged assets, related party matters, guarantees, contingencies, and other items that affect more than one part of the financial statements. Valuation allowances show carrying amount adjustments clearly. Instead of showing only one net amount, the statement or note can show the gross amount, the allowance or contra account, and the net carrying value. For example, equipment may be shown at cost, less accumulated depreciation, resulting in equipment net. This structure helps users understand both the original investment and the portion already consumed through use. The same logic applies to allowance for doubtful accounts, accumulated depreciation, bond discounts or premiums, and valuation allowances for deferred tax assets. This technique is powerful because it separates the starting amount from the adjustment. It tells users not just where the number ended, but how it got there. Now let us apply the idea through mini disclosure examples. An inventory policy note can identify the valuation basis, the cost method, what costs are included, and how slow-moving or obsolete inventory is reviewed. A depreciation note can explain that property and equipment are stated at cost, depreciation is computed using straight-line method, useful lives range from 3 to 40 years, and disposals are recognized in operating income. A pledged receivables note can cross-reference the debt note, and the debt note can cross-reference the receivables note. These examples show that good disclosure is not about decorative wording. It is about answering the reader's practical question: what method did the entity apply, and why does that matter to the number I am seeing? Let us close with 3 exam traps. First, do not repeat details that are already visible on the face of the statement. If the note says only, inventory was $412,000, it has not explained the accounting policy. Second, use plain English. Technical language is fine where needed, but boilerplate that hides the actual method is not useful. Third, cross-reference wisely. If the note says, see Note 6, then Note 6 must actually contain the relevant detail. ASC 235 is about relevance, accuracy, and clarity. If this lesson helped helped you, please like it, share it with your colleagues and classmates, subscribe to the channel, and support this free education mission. In the next video, we will test ASC 235 through MCQs and short answer practice, so you can convert this disclosure logic into exam-ready answers.